I think one mistake entrepreneurs make a lot is like trying to convince people who aren't interested to be interested, when in reality, it's actually about finding people that are interested.
Welcome to Fundraising Demystified, the podcast where we uncover the untold stories of successful founders who have raised venture capital to bring their visions to life. Join me, Jason Kirby, your host, as we dive into the hidden truths of the fundraising game. We'll explore different strategies, tactics, lessons learned from these entrepreneurs who have figured out how to win the fundraising game in their own way. Whether you're a budding entrepreneur, just getting started, or an established founder looking to scale your business, this podcast equips you with the knowledge and inspiration to conquer the fundraising landscape. Welcome to episode 6 of Fundraising Demystified. Today we have Brett Martin joining us today. He's the co-founder of Kumospace, a virtual office for remote and distributed teams that has gone on to raise a $21 million Series A led by Lightspeed Ventures. But what makes this story different than most is that Brett is also a VC himself and the co-founder of Charge Ventures, an early-stage VC fund. So in this episode, we're going to talk about how Brett couldn't resist becoming a co-founder of one of his portfolio companies, their fundraising journey leading up to their Series A, and the importance of timing their fundraise around an inflection point in the business, and much more. Let's go ahead and jump right in. Hey everyone, this is Jason Kirby here, founder and managing director of Thunder.vc, welcoming Brett Martin to the show. Thank you so much for joining us today.
Howdy, Jason. Thanks for having me. Excited to be here.
No, we're fortunate to have you, and it'd be great for you to tell the audience a little bit about your background and the fact that you're a VC and also the founder of Kumospace. So I'd love for you just to kind of take it away.
So I'm the co-founder and president of Kumospace. Kumospace is a virtual office for remote and distributed teams to show up in and work together every day. You can either call it a productivity software or a B2B metaverse, depending on who your audience is. I'm also the co-founder and GP at Charge Ventures. It's a New York-based pre-seed, seed stage venture capital firm. And then the little bit of time I have left, I eke out as a adjunct professor of data analytics and machine learning at Columbia Business School. So stay busy over here.
Yeah, you most certainly are. That's awesome. And it'd be great for you to kind of tell a little bit about the story of your role at Kumospace as a founder and kind of how that idea came to life.
Yeah, well, I was just investing full time at Charge. We're on our third fund in 8 years in, and during the pandemic. So when the pandemic hit, beforehand we used to throw a monthly happy hour for angel investors at Charge, and it was a great source of deal flow, a good way to kind of keep the network warm. And when the pandemic hit, everyone obviously couldn't do that, and everyone said, well, why don't you bring this online? And having a Zoom meeting for 50 of my friends every month didn't actually sound like that good of a time. And so I called up my old buddy and co-founder of multiple other companies. His name's Yang Mao. We've known each other, built 2 companies together. And I said, Yang, what are you up to? He said, well, I'm about to just quit my job and start another company in the mobile QA space. And I said, Yang, that you might make some money doing that, but that sounds so boring. Why don't we solve this massive problem around video conferencing and the fact that it's all kind of one to many, and there's nowhere you can have an organic conversation with multiple groups of people coming in and out of conversations. And that's how it started. So initially, he came back 2 weeks later with a prototype. And initially, I was just going to advise, and then I was just going to angel invest, and then I was going to invest out of the fund, and then we were going to incubate it out of the fund. And then it came time to, we were ready to raise, and he's like, are you just going to do this with me or what? And I said, okay, let's do it.
So you try to stay out of it, but couldn't resist.
The best ideas are like that.
No, it's awesome. And then, kind of what was the journey from you guys kind of bootstrap it to get it off the ground? Did you raise some initial capital? What was kind of the fundraising journey?
Well, as an investor, I feel like there's lots of things, if I see them and they have high growth and network effects and virality and technology moats and a good team, usually I'll just try to give them money and get out of the way. It's a lot easier way of making money than building. But with this particular one, the mission of Kumospace is so near and dear to my heart, which is how do you use technology to help people connect in more authentic sort of human interaction. And now we build virtual offices, so it's like people are spending all day on Zoom and having meetings, but they feel isolated. And how do you use technology to make them feel connected? That had a personal mission for me, and so we were lucky. We started building in May of 2020, and then launched it on the internet in August. And it's inherently viral, right? People are inviting their friends and meeting each other at Kumospace. So it just started growing organically. Nothing's perfectly organically. You still have to hawk it to all of your friends and email everyone you know. So obviously, we're doing all of that, and it just started to grow. And so we were going to raise a pre-seed, and in fact, Charge was going to lead that. That's my fund. But then it was already taking off, so we just kind of jumped straight to the seed. And Bold Start, which is a seed stage fund based in New York, old friends of mine. They're probably the best infrastructure fund in New York. They led it, and that was mostly based on a personal relationship. I had wanted to work with those guys for more than a decade.
No, that's amazing. I don't want to overshadow the fact that you just kind of downplayed it a little bit. Oh, we just sent it out to some friends to kind of get some initial traction. But really, what was that concerted effort to get that initial user base? Because obviously you're capitalizing on the fact that everyone feels disconnected. The world is shut down, and here's this alternative solution. But really, what was the effort that you guys put in terms of getting that initial traction?
Yeah, so I mean, we're lucky. We're product guys mostly, in the sense that if the product wasn't going to sell itself and spread itself, then we probably wouldn't be in this business. And so I think we're lucky in the sense that we use content. We viewed our Kumospace as the content, so meetings as content that could be shared and distributed. And so my thesis on any kind of social app is that you have to make it really easy to create, share, and consume compelling content. And if you can do that, then you have a chance to grow organically. So people were basically creating spaces, putting them Kumospaces, which is a little virtual world where you can have meetings or video chat in, and then they were sharing them with their friends, inviting their friends, and then we had a kind of a what they call K factor or virality. So for every one person that we added, they would probably add another half of a person. So for every two people that we brought into Kumospace, they would bring another person, and so things grow. You get kind of nice organic lift, and so we just obviously created lists. Look, 10 years in New York tech, we know a fair number of people who run events or who are also looking for technology solutions right then. And so, emailing them, getting in their hands, getting their feedback, and having them invite their friends. And so it really just started to grow, it really did grow organically with a little bit of a kickstart.
No, and I'm glad you bring up the virality factor. I feel like a lot of startups, especially if you're in the social space, trying to build a social app, if you don't have, a virality fact to your app, there's just no growth potential, at that point. And there's clearly not product market fit. So I'm glad you kind of bring up that point of just how you had a user get another user, organically. And so
on that note, actually, I saw a funny tweet the other day from Sam Altman, ran Y Combinator and now runs OpenAI, the ChatGPT startup, and he said, years of advising startups that they have to have a multiplayer baked in, inherent virality, etc. He's like, we have none of these at OpenAI. I don't know what I was talking about, which is funny because I do think that you look at the OpenAI chat product, it's like this thing is begging for a multiplayer use case. So it could grow, fastest growing startup of all time. It could grow even faster if they had actually put in the right social loops.
I know it was actually I saw that tweet too, and I thought it was hilarious. To just take every piece of advice with a grain of salt. At the end of the day, there are playbooks that work, and then there are playing outside the books, also works just depending on your situation. But again, what it really comes down to is product market fit. If you have a great product, it should be able to sell itself. And if you don't have that, then that what leads to ultimately, either having to pivot or find new alternatives. So you guys skip the pre-seed, so you get it off the ground, you get some momentum, you're on a hot market, you go straight to the seed. So walk us through how did you decide how much to raise, and how many VCs were involved in that particular round?
Yeah, I mean, it's funny. This trend toward everyone saying, okay, this is how much I'm raising. And I mean, we had a model and sort of said, okay, we think that we can, with a couple $1,000,000, we can probably get this to, several 100,000 MAUs, which we felt like would be sufficient to go raise an A. And, but I think from the outside, a lot of times, raising money looks like VC looks like a ATM machine where you insert a pitch deck and then out comes a couple $1,000,000. When in reality, most of these things are founded on multi-year relationships. That's how someone can feel comfortable, having a call with you and then giving you $1,000,000 is because they've already known you for 10 years and seen you, seen your career progression or, worked with you on, prior deals. So, we reached out to Bold Start. Frankly, the backstory there is that, on my first company, which is called Sonar, it's a long, convoluted story, but I was going to raise a round, and it was actually going to be a recap round, so kind of a painful round. And after months of trying to put it together, actually the Bold Start guys were the ones who put an offer on the table and were going to help me through it. Now that never actually materialized, and it's too early. It's 10 a.m. here. I need a beer to tell that story, but. I always wanted to work with them, and I remembered, them being like, okay, these are people I want to work with. And so I built shared deals with them for the next 10 years. And then when it came time, I took 10 years between startups. When it came time to run it back, they were the top people on my list. So, basically I pinged a couple folks on a Friday afternoon, and, said, hey, I pinged Bold Start on Saturday at 11. By 12:30, we were in Kumospace, in our product, having a meeting, and then by Monday we had basically shook hands on terms. So that's how fast the market was moving in 2021. But I honestly think that's just how fast Bold Start works generally. So to show you how quickly you have to move to get a deal.
Well, and see, I think that's something also. Like, granted, 2020, 2021 were a bit of the anomaly years, and things are slowing down. But like that kind of gut instinct, or that quick buy-in, whether you get a term sheet immediately, but when you start to see the other side of the table engage that quickly, again, like product market fit, building something that's solving a big problem, like these boxes being checked that quickly. And now, granted, you have the relationship, so that makes things accelerate a lot faster because there's the inherent trust that doesn't have to be, start from scratch. But I feel a lot of founders come in and, if the VC is not going back and forth with you, and, and having that kind of banter back and forth to establish the opportunity, then a lot of founders, need to realize that that's probably not going to work out or not going to be a fit. And in your case, you had the relationship. It was quick and fast, and I would say accelerated to the extreme given just the state of the market, back then. And so that was just the seed round, correct?
Correct.
And so you guys raised a couple $1,000,000. What happened thereafter? Did you guys hit your milestones and then set up a Series A? Like, what kind of happened to the business after you raised that money?
So we raised that seed, and we took some money from some other angels that we really wanted to be part of the round, and then it became time to build. I mean, to be fair, at that point, Kumospace was only 2 employees. We had hired, we had one MBA, from Columbia who was helping us out, and I think we had just hired a consultant. So it was really just me and Yang at that point. And so we took the seed money, and actually built out a little bit of a team, hired some additional engineers, and sort of took what was essentially a proof of concept and re-platformed it so that it could scale. And what happened was then is we're continuing to grow organically. We were kind of doing hand-to-hand combat stuff to grow, and then one week we had this crazy spike in users, and we're like, where did that come from? What happened? And traced it down, found this random TikTok post, that some TikTok user had posted about having a tea party in Kumospace, and we were like, oh wow, that's pretty interesting, and how the power of social here for driving traffic, and so we said, okay, can we recreate this? And so we started doing influencer marketing and driving traffic, but we couldn't figure out how to scale it. So, it's pretty laborious. I'm not sure if folks here have done influencer. I feel like it's probably the best channel still today, especially after all these changes that, Apple and Facebook made for advertising. Anyway, it's, you got to find the people that are relevant to your audience. You got to figure out how to get in touch with them. You have to email them. You have to, negotiate with them, get them your content, track it, give them a UTM tracking code, see how it performs, right? It's a pretty manual process. And so we spent several months trying to figure out, okay, how do we actually scale this? And then we eventually got some good software in place. We actually use this company called Grin that I'm an angel investor in, that does influencer marketing software and basically helps with that whole sort of sourcing to supplying to tracking influencers. And we eventually got that running, and so we could scale up. So, we figured out how to do, okay, we can actually have 10, 20, 30 people posting about Kumospace. And that, because we have that content, right? We talked about sort of like video chat as content. We were just, getting that all over social, and we were requiring users for like less than 10 cents a registration, which is obviously pretty cost effective customer acquisition. And we sort of kind of realized, okay, we had that set up, and then in the fall of late fall, pretty much the end of 2022, we said, okay, we've got this thing growing, we're growing, we got hundreds of thousands of, monthly active users kind of growing. Now let's throw a monetization in. So, we released our first sort of paid product, and, it pretty much ripped. I mean, we went from like 0 to, close to $1 million run rate in 3 months. And so, obviously that was the right time, to fundraise, when you have everything going up and to the right, it doesn't always last. So when you've got it, I think as an entrepreneur, you got to capitalize on it. And that's when we went out for the A.
So beautifully said. And that's what I coach so many founders on, is inflection points. Like, how can you time your fundraise around an inflection point where everything just kind of ramps up? Because, it could be short-lived. And if it's short-lived, you want to get that capital in the door as quickly as possible, because if it starts to level off, then investors like, oh, maybe this isn't so hot, or terms start to change a little bit. So that's incredible to kind of hear how you guys leverage that so quickly. And then, so you kind of flip on the monetization. Imagine subscription for, teams or companies to kind of pay per user. Is that effectively the model?
Yeah. Well, I mean, we've iterated a bunch of times since then, but at the time, I think we were doing kind of a capacity-based pricing, sort of like probably like how you price a wedding or something. You have a space for 100 people, kind of with the real estate analogy. Since then, I think we've moved toward more of a traditional per seat per seat per employee per month sort of model. Really simple, right down the middle.
No, that makes sense. And what was, pivoting on the model, kind of what was Did you deal with any pushback from customers? Was it more of a clear fit and that's why you did it and customers liked it? Or did you have any pushback from your existing paying customers that ramped up so quickly?
Oh, I think one thing I think that we definitely did, and a lot of entrepreneurs um, do, is you're really precious about pricing. I remember the first time before we launched pricing, I spent literally a month thinking through, you know, 10 different pricing models and modeled them out and, agonized over the decision. And I think, then we launched it and, sometimes some of it works, some of it doesn't. And, and now we just change pricing all the time. We just are constantly changing. I think every month we probably try something different with pricing just because, you realize that as a startup, it's like you're, you can't be too worried about upsetting the your existing customers, not because they're not important. They're obviously super important, but just that you know for you to work for them, you need to find a sustainable business model that works. And so if it's not working, then it's not really going to serve them long term either. So you have to keep iterating quickly, and you realize just not to be so precious with it, because the if you're going to be 10x in a year, that's way more important than not rocking the boat for where you are today.
Yeah, no, I completely agree with that sentiment. And so you guys hit this inflection point. You're monetizing. You're getting to a million ARR very quickly. So what happens when you go out for the A? Like, walk us through that process of how you kind of say, all right, now's the time, and then how did you execute to close, and what was that timeline?
Well, yeah, I mean, I think that the process is, working with, if you already have raised, right? So you're going out for A, so you already have all your seed investors, right? I think you get everyone lined up. You get your Google CRM, your Google Sheet. You put in all of the people that you already know, or you've been wanting to work with. You solicit all the referrals from your existing investors, and you kind of rank order them, prioritize them. You do a couple kind of quote unquote throwaway meetings with people that you probably don't aren't your first pick, but you can at least get the get the kinks out of the presentation, and then then it's just having all your docs in place, having everything orderly, and then what I like to do is I call it like FOMO fundraising. Essentially, you have to maximize FOMO for investors, because it's all about creating heat on your deal. So in this case, I think the best is you pick a couple people that 6 months in advance. You say, okay, this is the 4 or 5 people I really want to work with, and so you meet those people. You tell them what you're going to do. You meet them 3 months later. You have your checkup. You show proof of execution. So you showed them, hey, this is what I said I was going to do. I did exactly this, right? So you're starting to connect the dots on your ability to execute. And then ideally, right before you do your fundraise, release some news, or you create some catalyst. You launch a new product, you get some press, right? Which has them wanting to talk to you, right? And then they come to you. So in an ideal world, you can kind of coordinate all this, and then you kick off your fundraise. Same thing, hey, close people. I'll tell you on Friday, we're gonna start fundraising next week. I'm giving you the weekend head start. If you're really interested, they'll lean in, and then on that Monday, you just email your first 10 people, and then you kind of keep adding to people to the pipe, as many as you can manage. Now, you don't want to email everyone, because you'll just get swamped down. You won't be able to respond to things timely, and timeliness is so important. But I think it's probably you have about 10, 15 people in your pipeline at any given time, and then just keep, as people drop out, you keep adding in maybe 2x as many to keep the pressure going, and you'll know pretty quickly. Like, I think one mistake entrepreneurs make a lot is like trying to convince people who aren't interested to be interested, when in reality, it's actually about finding people that are interested. So it's more of a, just getting more people into the top of the funnel.
I love the don't convince people that aren't interested. There's so much like chasing of investors that gave a no or kind of get or ambiguous or like, come back later, clearly not leaning in. And there's this like, oh, but if I just give him this one piece of information, it's going to change his mind. And it's like never works. Like maybe 0.01% of the time. But it's out of that Dumb and Dumber, like, oh, so you're saying I got a chance? It's like it's not usually worth pursuing in most cases.
It's a bad use of everyone's time, and investors have a hard time with it just because they don't want to miss the next big thing, and they want to keep optionality. So they are never trying to say no at the end of the day. But you spending your time trying to convince them is a terrible use of time. Just find more people, and it always works best when you find the person who is already looking for what you're building, right? Like they have the idea in their head. They're like, man, this is such a great idea. And then you show it to them. That works amazing because then they feel like it's their idea, right? You need to make investors feel like your idea is their idea. And that's the easiest way to get them across the finish line.
That's well said. And so when did you guys go out to market for your Series A? When was that kind of like that beginning that initial outreach?
Yeah, I mean, we were trying to take, that you can feel the market was hot at the end of Q4, 21, right? And so we sort of realized, okay, we got to, I think the other thing that entrepreneurs realize is, for me, I think it's so much about predictability, right? What investors are terrified of is unpredictability. They want to see just consistent growth, right? And looks very predictable and like, okay, this trend line is going to keep going in the same direction. And so what I recommend is, when can you basically predict that can you manufacture 6 months of steady growth? You need the first 3 months, when you think you can predict 6 months of growth, that's when you're ready to start your fundraise. Now, you basically, the first 3 months are creating the track record. And then once you have 3 months of growth, and this is really, for really a seed or Series A company, once you have 3 months, okay, now can you absolutely guarantee you can do 3 more months? Because what you can't have is your growth peter out while you're in the middle of your fundraise. But once you have 3 months, and then if you think you can do another 3 months, then it's go time. And you basically have to have, what are the 10 tricks up your sleeve that you can use to control that growth, right? Is it adding new markets? Is it adding new channels? Is it, couple customer deals that you have in the pipeline that, you can close in the next 3 months? So how can you control that so that as you're fundraising, you're going out, you have solid, 3 months of track record. And as you're fundraising, each month that goes by, you can update investors with, hey, here's another 20, 30% growth month, right? And so much of it is like creating that window where you can control the predictability and share that with investors. Because the worst thing that can happen to you is you're in the middle raising and, oh, I have a down month. Because you're not just like out a month. You're actually screwed for another 3 or 4 months until you can build that predictable track record again.
Oh man, it's such a harsh but true reality that I think a lot of founders need to take into consideration as they go out to raise. Because a lot of them are like, okay, now we need money. It's like, nah, that's not going to work. Most cases, like, if you don't have that manufactured growth, you don't have like everything you just kind of said, it just becomes a massive uphill battle, to try to convince investors to take a leap of faith on you. And it's, how can you mitigate risk as much as possible for the VC in terms of creating that predictability and that consistent growth? That makes it a lot easier for a buy-in from an investor as opposed to choppy growth, which becomes a more difficult battle.
And some people might, say, "Oh, is that disingenuous or something?" And it's like, well, actually, no. That's what public market investors are looking for as well, right? If you look at a public marketly traded company, like that's why SaaS companies get valued so highly, is because they have nice, predictable revenue streams and steady growth. And when people miss estimates, that's when the stock gets clobbered. And so, it's really just the same thing on a smaller scale. If you can create predictable growth as a seed stage startup, well, that's super valuable, right? That's what investors, that's what they're looking for.
And so let's go back to the timeline. So you kind of picked up on the market's hot Q4 2021. but that was kind of where we saw the peak, really, of peak hotness. There's still stuff happening, but definitely started plummeting. But is that when you started the growth, kind of manufacturing the growth over the next 6 months? Like, what was that?
Yeah, I think look, we obviously great timing, got lucky, in terms of the market cycle. I'm not even trying to pretend like we had, you know, the visibility, we knew when the top of the cycle was going to be. So, we got lucky. There's no question. What I think is the probably takeaway for entrepreneurs is more, you know, when you when you basically have we had created this predictable growth machine, right, from the marketing side. We knew how to scale, and we knew that we could control growth. And so we were, that's when we knew it was time to start thinking about fundraising. And then we took a risk around monetization, right? That was unclear. But then when that worked out again in our favor and started, ramping, like, I think there's where a lot of people get mixed up and they say, oh, okay, well, we're going to get, we'll just keep growing for a few more months, 6 more months, and then we're going to raise it an even bigger valuation, right? The truth is that multiple and what investors will pay, it's yes, the absolute number, right? It's like, yes, I'm making X million dollars, in revenue run rate, and then I'm getting some sort of multiple on top of that. But it's as much the growth and as much the consistency of growth. And so, like, you have to weigh, okay, yeah, I might be making twice as much revenue, in 6 months, but am I going to be growing half as fast? And that is actually, investors, when they're looking at your trend line, they're extrapolating out, right? And they're usually, have a rosy, estimate. If they're excited about your company, they're going to, guess to the upside. And so you'd rather actually have that shorter but steeper curve to raise than, taking the risk of, okay, well, what if my growth is slowed down in 6 months? And so I think, the thing we did right was kind of pushing forward our fundraise as soon as the revenue started working and saying, okay, it may never get better than this. Let's hop on it and take advantage.
And I think that's, correct me if I'm wrong, but being you were a founder prior to being a VC, and became a VC and back into the founder seat, kind of juggling all roles. Like, what kind of insights, and I feel like what you shared is, kind of the insights that you uniquely gathered of your experience, kind of being on the other side, and being able to play those cards that probably convinced you into a deal, and using those to convince others into a deal. Is that a safe assumption?
Yeah, 100%. I mean, look, I obviously invested in things that, that right before the investment, everything is up and to the right. And then you invest, and then, things go limp or sideways, and it's not even like that happens. That happens all the time to investors, right? Like, everything is obviously put together to try to make the best possible picture and part of fundraising. And that's just part of entrepreneurs doing their job. I mean, I don't get upset when that happens. I'm, trying to avoid it, but it does happen. And so, having seen that as an investor a few times, it's like, okay, I understand what is compelling and attractive, and how do I, how do I take advantage of these dynamics? The other thing is, like, as an investor, I've seen is, well, actually, that's from being an entrepreneur. I learned from my first company, time kills deals. Is just a really important concept, I think, for anyone fundraising, is to realize that time kills deals. And so everything is about moving fast and keeping things moving. And if things slow down, that's where you die. And I think a lot of entrepreneurs, it's crazy. They get hung up on this term or that term, or valuation, and then they kind of hem back and forth. And it's like, hey, if you don't have a term sheet yet, you really don't have any ground to stand on, unless you're profitable, right? Which is not the case for most seed stage companies. So in all of my experience, I've just learned, I've learned the hard way. Okay, over negotiating it doesn't make any sense. And if you don't have other options, like, all that matters is getting options on the table, and then building up from there.
I completely agree with the statement of time kills deals. Like happened to me at a previous company we were selling to Samsung, had an acquisition offer. Everything was amazing. It was perfect across the board, but our board wanted to push for more, and we're like, no, we're good. Let's just stay with what we got. And they got aggressive and like really pushed hard, and that killed about 3 weeks. Well, if you don't know the story, back in 2017, Samsung had a whole regime change, and the day before closing, the new CEO had signature authority and killed every deal on the table. We lost by hours. We had champagne at the office. We had like buses loaded up to take everyone to the Samsung. It was just like it's gonna be this amazing day. And since Korea starts, hours before we do, we like wake up to a text message from the corporate dev team. They're just like, "It's dead." And we're like,
That's the worst story. I have a similar one, and I'm so sorry.
"Well, we ended up selling to Walmart. Everything was fine, but it was, just again like unnecessary negotiation. Like don't get greedy when things are good, and let good things happen. And what they were fighting for was so insignificant, to everyone on the table. But to each their own when that stuff kind of happens. But I'm glad you mentioned that, just because, and also just from a founder's perspective of like, if you're not seeing momentum happen on the other side, if the VC is not acting quickly, or at least responsive and quick, like it's probably best to be looking at other, investors or other VCs, and not necessarily get hung up or put all your eggs in one basket. No, they'll come through. And, in a lot of cases that doesn't happen. Like, VC found a better deal. There's a better opportunity on the table that they can allocate capital to. And, if you didn't get a term sheet, that's very much a possibility. And I think founders just get so hung up when they get a nibble on the hook, and they want to reel it in. But, in most cases, it's a lost fish.
Especially in this market, right? Like, it's been a brutal fundraising market, and I honestly think it's going to keep getting worse. Like, I don't think we've even seen the mass startup extinction event that is looming. People are still, working off their war chest that they raised in 2020, 2021. And, they haven't, a lot of people who raised at inflated valuations haven't had to go back out the market, or they raised seed extensions last year. And so, I think it's going to get worse before it gets better. And so what I'm seeing, the really savvy entrepreneurs are, one, they've obviously reduced costs and prolonged runway, but they're also just getting cash in. They're not being squeamish about, oh, it's a down round or whatever. They're just getting the deals done because they know that the survival is the name of the game for the next couple of years.
Yeah, no, there's definitely, I can have a whole thesis right now that we're going to see some massive consolidation. There's this so much money invested into tech and talent over the last several years in this big boom cycle that the founders weren't quick enough to respond to the market dynamics and the fact that capital is just going to dry up, and they're not going to be able to sustain operations, but they maybe built something valuable or have a team that's valuable. And we'll start to see those that were smart and have cash on hand were able to continue to raise, or big conglomerates coming in and just gobbling those companies up. And there's a lot of Me Too companies out there that all kind of raised on similar premises of other successful companies. So we're going to start to see probably the top two in those spaces get acquired, and the rest kind of fall out. And I think you're right. I think we're going to continue to see a mass exodus as capital becomes more and more difficult to raise in this market.
100%. So get it while you can. Get whatever you can while you can.
Yeah. And also, like, I think building those relationships with VCs, even when you're not raising, I think is something that, you've had the fortunate ability, you've been a founder in the past, you have a long history, and those relationships have really helped you capitalize on a quick raise and build clout and credibility but also, not that you had a crappy business, it's like you were, accelerating growth, you were building something great, and the relationships added to it creates a unique effect where you're able to kind of raise larger sums of capital quicker than, say, someone that doesn't have that pedigree or that experience leading up to it. So at least from Crunchbase, it says you guys closed this round in August. Is that when you actually closed the round, or is that when you just made it public last year?
Oh yeah. Well, you with these larger rounds, you don't close it all first. So you can get a lead and then you can fill out the rest. So we, locked down at the end of the year and then we filled out throughout 2022 or 2022. Yeah.
Yeah. And then as far as how Kumospace is doing now, like kind of what's been the journey after raising that capital and kind of where do you see see the future of Kumospace going?
I mean, got a few million users now. We've got, tens of thousands of folks sitting in it for using the virtual office use case in particular, which is how we monetize. So people still use it for friends and social and education and events and things like that. But then, our main business model is providing virtual office space for sort of distributed teams. And, we get people sitting in there 6.5, 7 hours a day, working all day in Kumospace. So yeah, if there's any, founders, it works great for founders. I think, there's this whole kind of return to the office, debate going on. And I don't know if you read the, Andy Jassy, CEO of Amazon, like memo, bringing people back to the office, why to do it. I agree with a lot of reasons why people are dragging people back to the office in the sense that, better collaboration, build a strong culture. If you're a manager, you want to know what your team's doing so you can, help them out. I just don't think you need to build a box, concrete box to do that. I think you can get a lot of those benefits with a virtual office solution like Kumospace. So I think if anyone, if your founders are, and I think as a startup, one of the being able to hire and offer perks like remote work is actually one of the few competitive advantages you have. So, if anyone's looking to take advantage of that, definitely hit me up.
No, it's great to hear. And I agree with you. I think there's a fine line of the coming back to office. I love the hybrid model where, you kind of get to come to these larger companies. What I think a lot of people don't always realize is you may be coming to whatever the San Francisco office, but maybe your team or your direct reports or your managers are in the New York office or the Austin office, and they're still kind of spread around. You're not always necessarily close to your team. So this is where, something like Kumospace, you could be in a physical office, but with your remote team, in Kumospace and something like that. So I see it very much just a hybrid solution that gives people a lot more flexibility that is a good fit for their business. And not necessarily this cookie cutter. Everyone's got to be in the office or everyone has to be remote. And it's more of founders have the option to kind of choose what's best for them from recruiting and retaining talent. Now that these tools like Kumospace exist,
100%. We're not. We have in-person offsites twice a year because we totally appreciate the value. I think it's more just like a inverted model, right? The inverted classroom where they used to lecture in class and do your homework at night, and now you watch a lecture on video and then you do your homework in class where the teacher can, give you personalized attention. I think something similar is happening with work where you say, hey, look, we meet in person to do really, protracted brainstorming or to build, personal relationships, and then we do most of our work from home or, wherever we want because, fundamentally, what are we doing other than sitting on a computer?
exactly. Well, as we come to wrap here, you've already given a ton of really good nuggets of advice to founders looking at Raise by just sharing your story. But if you were to provide any additional information that you haven't shared already, or wanted to kind of leave a founder with a final point when they're coming to prepare for a fundraise, what would be your advice?
I think completely simplifying your message is, the one thing. If we look at all the YC companies every year, and the thing that YCC has perfected is the clear, compelling, investor pitch, right? Like they have a process, and everyone runs the playbook. And when you're a VC and you look at it, you're like, oh my God, all these companies look the same, but they all look the same good. And, it's hard to tell what is good or what's not because but they have really perfected, okay, less information is more, simple, plain English, traction, controlling that process. I think there's a lot to be learned from them. I think they also have a lot of, I would say, tactics that work against them, such as, being dogmatic about the price or, oh, I'm only raising around 20 cap. I wouldn't recommend those things. I think a lot of those things are actually good for Y Combinator, but not necessarily good for the company. But I do think that founders can learn a lot by looking at their pitches. And yeah, a lot of those are online and on YouTube. So, you can check them out and learn from just being really crystal clear and not overloading the investor with too much information.
I work on that every day with founders of just like, how can we delineate this to like one clear point as opposed to like, here's 40 data points on one slide. Don't you want to know all the research I've done? I put a lot of work into this and I want to show you how much work I did.
Kill your babies. Don't be afraid to kill your babies.
Don't be afraid to kill your babies. It's a hard thing for a founder to come to a realization on, but it's very much an important piece of advice, and I appreciate you leaving that note for founders. Really appreciate you being on the show. How can founders follow you or learn more about what you're doing at either Charge or Kumospace?
Yeah, so just feel free to hit me up. I'm on Twitter, Brett BRETT1211, or hit me up on LinkedIn. If you're looking for a virtual office space, just reference this podcast, and we'll definitely hook you up. And if you're a pre-seed or seed stage founder looking for capital, especially if you're based in New York, would love to hear from you. Brett at charge.vc. So thanks so much for having me.
All right, I appreciate that, and I apologize for the bombardment of inbound that you might get when this goes live.
Yeah, what a terrible problem to have.
I know, right? All right, well, Brad, really appreciate you being on the show. Thank you so much, and good luck on the journey with Kumospace.
Thanks, Jason.